Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Yesterday afternoon, the Reserve Bank Board left interest rates on hold. The benchmark rate stays at 4.35%. No surprises there, with financial markets tipping a reduction in rates some point next year. The Reserve Bank Governor Michele Bullock is very much sticking to the line that they're not ruling anything in, or not ruling anything out for that matter, reiterating that inflation continues to be too high. I'm joined today by Westpac's Chief Economist, Luci Ellis. As I've mentioned before, Luci has a unique insight into the way the Reserve Bank makes decisions, having been the Assistant Governor at the Reserve Bank and the Chief Economist until late last year. Luci Ellis, welcome back to Fear and Greed.
Thanks very much, Sean. Lovely to be here.
What do you make out of yesterday's statement on monetary policy, which came out, as well as Michele Bullock's press conference and the statement after the board meeting?
Well, the decision to keep rates on hold was widely expected, and it was recognised in that package of communication that inflation has come down. As we expected, they highlighted the fact that underlying inflation is still too high, and they're looking through the much larger decline in headline inflation because, of course, that's been largely driven by the electricity rebate. So they're looking through that. They're expecting a pickup in headline inflation next year once the rebates expire, and they're focusing on measures like trimmed mean inflation to get the underlying trend. Now, while trimmed mean inflation is coming down, it is still a good half of a point above the top of the RBA's 2 to 3% target range. And it hasn't been coming down that quickly on a quarterly basis. And they're the sort of things that the RBA has been very mindful of. Now, they did slightly shave their inflation forecast, their trimmed mean inflation forecasts, by a little right through the horizon, because trimmed mean inflation already got to the level at the year-ended September quarter that they are expecting year-end December quarter. So if anything, they're a little bit ahead of schedule relative to what they previously expected. But broadly speaking, the outlook is not that different from what they were previously expecting. A bit softer growth, a bit lower wages growth, a very marginal decline in inflation. But they're mindful of the upside risks. Because inflation is still above the band, you've got to be more vigilant to the upside risks, even if the risks around your forecast are balanced, as they are. And so they're still keeping on with the not ruling anything in or out language, still keeping on with the vigilant language, vigilant to upside risks. So in many respects, it was a relatively straight bat, unchanged sort of outlook compared with what they had in August or indeed September.
Okay, so for we outside pundits, as opposed to those inside and people like yourself who have been inside, do you think there would ever have been some sort of inclination to soften the language just a bit? I mean, they're firmly in neutral, it seems, but given the trajectory of inflation, given those forecasts that they have shaved marginally that you went through, I mean, I suppose we all were hoping that they'd lean into the idea that rates, the next move in rates would be down, but they're not even doing that really, whilst everyone expects that. They're not even saying that really, are they?
You're right, Sean. The governor refused to be drawn on the outlook for the cash rate in the first half of next year. You could argue that's a little bit less hawkish than they were in August, where she was quite explicit about not considering a near-term rate cut as being consistent with their strategy. She didn't actually say that a near-term rate cut was inconsistent, but on the other hand, you did get the sense that they were more comfortable with market pricing, which has pushed the timing of that rate cut out a little bit. I do think that part of what's going on is that even though the disinflation is on track, inflation is declining, as well or perhaps even a little faster as they expected, they've also become a little bit more nervous about tightness in the labour market. And over a sequence of meetings, they've become progressively more pessimistic about supply capacity in the Australian economy. And this is something we've been talking about a bit in recent times.
Stay with me, Luci. We'll be back in a minute. I'm speaking to Luci Ellis, Group Chief Economist at Westpac. What about household spending? They talked a bit about that, and they also talked about exogenous factors overseas, Ukraine, Middle East, US election. Again, Michele Bullock wasn't drawn on that, but these are all factors that they're talking about. It seemed to me that household spending, they are a little bit concerned about that falling too much.
That's absolutely right. The risks that they assessed on consumption were on the downside, and they outright said that they expect that real consumption will be flat in the September quarter. So, further weakness in consumption. But in the end, what they're focused on is the balance of aggregate demand and aggregate supply. And this is, really an evolution of the way they're conducting policy and analysing the economy that's happened in the wake of the RBA review. And so even though consumption's weak, they're looking at the whole economy and they're saying in their assessment, the level of demand is still outstripping their assessment of the level of supply. And that's why some of the communication they had around the labour market was so impactful. They're really seeing the labour market as still being too tight, and they pointed to a number of indicators where they're saying, well, this isn't easing anymore. So average hours worked isn't easing anymore. Some of the business survey measures aren't suggesting loosening labour market conditions in the recent times compared with, although there has loosened a lot since a year or so ago. And as a consequence of all that, they're sort of saying, well, we still think the level of supply is low. And so therefore the level of demand that's sustainable while still keeping the disinflation on track is pretty weak. That's the way they're thinking about the economy at the moment.
Government spending always comes up as a reason, depending on which media outlet you're talking to, it's inflationary or not. Michele Bullock yesterday really didn't want to be drawn into government spending, particularly around federal elections, that type of thing. So park what the Reserve Bank thinks. Do you think, Luci, that government spending is providing an extra challenge for the Reserve Bank simply because fiscal policy isn't doing much of a job in retarding the economy?
Well, I think there are aspects of fiscal policy that have done enormous lifting in keeping demand dampened. You've got to remember that the tax take from the Australian household sector reached an all-time high as a share of income in recent times, just ahead of the stage 3 tax cuts. And in fact, the tax take was surprisingly strong in the June quarter, just ahead of those tax cuts. The level of the federal government's deficit, and indeed they ran 2 surpluses and the deficit's quite small. So, all of these things need to be taken in context. And I think where the RBA is heading, and an important way to frame this is, if you truly believe that the aggregate supply in the economy is this weak, then any extra dollar of demand is a problem, and it doesn't matter who's spending it.
Yeah.
It so happens that with consumption this week, there's been sort of a call for more government spending. And of course, as the governor pointed out in the press conference, there is a certain amount of reallocation of spending between the private sector and the public sector. So, those electricity rebates, what they're doing is removing a certain amount of spending on electricity from private consumption, household consumption, and moving it to be recorded as public consumption. So some of this is just pure reallocation. But in the end, it's the aggregate level of demand that matters relative to the level. So the aggregate level of demand has been growing very slowly, as the governor acknowledged in the press conference. But it's all about their assessment of aggregate supply and how weak that is. And, it doesn't matter who's spending the extra dollar, that would be a problem.
Luci, Ellis, Chief Economist at Westpac. Then when will we see the next move in interest rates? And I'm assuming you're going to say you expect that the next move will be down.
You're right, Sean. I do expect that the next rate move will be down. Our current view is that it's going to be in February, but a lot can happen between now and then. We certainly don't think that they're going to be cutting rates in December. And, I think any vestiges of people's idea that you could have a rate cut after the December meeting has pretty much been eliminated by the slightly more hawkish tone than expected in the bank's communication yesterday.
Luci, thank you for talking to Fear and Greed.
Thanks very much, Sean. Always a pleasure.
That was Luci Ellis, Group Chief Economist at Westpac. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.